Hello, I am Mijun from the American Stock Exchange University. Let's start today's United States stock news on April 21st. Welcome to Mijun, who is consistently maintaining the stronghold of United States stock investment, and thank you for coming today, Mijun. Ladies and gentlemen, it's been a while since I last greeted you. I wasn't able to send out the regular broadcast of Mijun for a week, but when I shared a simple video with you, all using artificial intelligence voice, it seemed like many of you were waiting for the regular broadcast during that time. Last week I traveled to Barcelona, Spain with my family. It's the same in the United Kingdom as in the United States. Around this time every year there is a summer vacation. So the kids get to take a break from school for as long as 3 weeks, and I can't just leave them alone for 3 weeks. So I had no choice but to travel with them, but as expected, it was very physically challenging. So now I have to upload content as a member of the beauty community every day, and I also have to travel around Barcelona with the kids. Personally, I spent a very tiring week. During that time, the United States stock market wasn't doing so well either, so I think a lot of you were waiting for the United States market broadcast. Now that I'm back to my normal life, the vacation is not over yet. There are still a few days left, but I will try to send regular broadcasts from today. Well then, let's start today's big news, the news of April 21st, which we meet after a long time. Last week, the United States stock market only operated for 4 days and it closed on last Friday. On today's broadcast, since there are no such big news or new news, we will try to summarize what interesting news there were in the United States stock market during the past week. First of all, if you look at the S&P 500 index, contrary to what you might think, red is not the dominant color, rather it's dark. However, most of the red is from mega tech companies with a huge market cap. So overall, the movement of the three major indices was not good, but the breadth of the market has actually widened, which can be summarized in this way. If you look at the movement of the three major indices, over the past 5 days, the Dow has been down 2.62%, the Nasdaq has been down 2.27%, and the S&P 500 has also been down 1.41%, which is not good. However, it seems possible to summarize in such a way that it was a week when small stocks such as mid-caps, small caps, and micro-caps saw their stock prices rise significantly, while overall smaller stocks were rising and large-cap stocks were falling. If you look at the current market trend, it's holding at 24.45. The momentum is extremely weak because 25% of the stocks that make up the S&P 500 are still not on an upward trend. However, this figure has dropped to 5.16 not long ago. Therefore, the market has expanded significantly from 5.16% to 24.45%. We can examine the unstable trend. Next, we will look at the volatility index VIX. The VIX is also the same. Because of 3270, the distribution coefficient is still showing a lot of volatility. However, this number is not long ago. Even in April 8th, it shot 5233. So if you compare it with a week ago, the volatility has decreased a lot, and it can be interpreted in this way. The distribution exploration index, fear and greed index remains unchanged in the 20s as of the 20th. That story is still spreading extreme fear in the market. You can see it this way. This number, even a few days ago, if you look here, the date is April 8th. It fell to as low as 3 on April 8th. The fear index represents a drastic number of 3, and since then it is now in a somewhat recovered situation. All 3 indicators are showing a similar trend. The market score provided by Choice Stack is also the same. It is still stuck at 23 and has not been able to get out of the fear phase. However, let me explain again, when you are stuck in the fear phase, you should not fall into fear. Currently, because the market has been swept away by excessive fear, it can be interpreted optimistically that there is an opportunity to aggressively buy undervalued assets. The results of the American Association of Individual Investors survey announced last Thursday are the same. 28.5 and 25.4, so the atmosphere has worsened. So currently, only about 1/4 of the market participants are expecting a bullish trend. 56.9% of the respondents still believe that the market will be lower than the current level in 6 months. It seems that we can sort out the sentiment of the market in this way, as non-binding opinions are influencing the market. Next is the score of the United States weekly top picks. It did go up more than half during the last week. As you can see now, 5, 6, 7, 8, 9, 10 types have risen for a week and 8 types have fallen. MicroStrategy rose 16.47% over the week, the best performer. Secondly, 13.28% and 9.88%. In addition, 6.75%, 6.06%, 5.86%, Vistra by 5.64%, and Talon Energy by 3.60%. Bitcoin rose by 1.76% and is at 87,610. Lastly, TSMC also ended in the positive, rising by 0.4%. Next, all the stocks fell, with Broadcom dropping 0.76% over the week. Alphabet negative 1.09%, Credit Technology negative 4.21%, Tesla negative 4.37%, Amazon negative 4.75%, Nvidia negative 5.65%, Meta negative 8.20%. Finally, Innovator had the worst performance, falling by 10.65%. Here you can see Tesla, Amazon, Nvidia, Meta, and Alphabet as well. Therefore, we were able to confirm once again that the stock market did not perform well over the past week, mainly due to megatech companies. As you can see, last week the megatech companies dominated the market, causing a downturn. That's how you should see it. Well, there were various reasons why we could see a not-so-good trend, mainly due to Taikuju. Last week, there was a disaster every day from Monday to Thursday, and this time, I will take a moment to look at what the most important news was. First of all, on Monday of last week, Nvidia announced some not-so-good news. They warned that they could lose $55 million due to the Trump administration's China ban. If you look at the main content for a moment, the Trump administration imposed a heavy license requirement on Nvidia's H20 chip for export to China. And after this measure was announced, Nvidia could suffer a significant valuation loss of $55 million and a sales loss of up to $140 million to $180 million. We have released such extremely negative news to the market. After this announcement, Nvidia's stock immediately fell by 6%, casting a negative impact on the entire industry. This led to a general market downturn, and there was one main reason for this, as you can see. Next is Tuesday, and there was also an important piece of news on Tuesday. There was extremely negative news that the S&P 500 formed a death cross for the first time since 2022. A death cross was formed where the 50-day moving average falls below the 200-day moving average. This news has been conveyed to the market, and as many of you know, a death cross signifies that the market sentiment has turned negative in the short term. However, if we look at past data, there have been many instances where the S&P 500 has rebounded after a short-term drop following a death cross. So, this phenomenon occurs when the 50-day moving average falls below the 200-day moving average. The United States stock market has declined further many times in the short term. However, from a medium-term perspective, if we look at 6 months later or a year later, the United States stock market has invariably been on the rise, which can also be interpreted positively. As you can see here, the 5,500-point turnaround is seen as a crucial factor for the future market recovery. At present, the United States stock market is somewhat weakened due to the breaking of the extremely important support line of 5,500, and it seems correct to understand it in this way. Next, we move on to Wednesday. There was also extremely important news on Wednesday, and the market atmosphere was not good. Chairman Powell made such a statement. There is no annual push. It's hard now because there is no Trump push. And when the announcement that there is no annual push is made, the United States stock market can only plummet again. A very bad news was announced. Chairman Powell, who appeared in the public hearing on Wednesday, he emphasized the need to monitor economic indicators additionally before adjusting the interest rate. He reiterated that the risk is still too high to move, so he will make a decision based on the data that continues to be released additionally. Up to here is fine, but from here is the problem. The Trump administration's tax policy has raised prices, and there is a high risk of triggering a labor shortage at the same time, thus a warning message was sent. During the remaining period of this year, there will be no progress or exceed the annual targets of inflation and employment, thus a gloomy forecast was presented. And decisively, even if the market is urgent, it cannot be opened. There is no plan. It was clearly mentioned like this. That story is that we don't have the Fed put we've been waiting for. That's what it said. While doing so, it reaffirmed the independence of the Federal Reserve without legal and political pressure. This story is about Trump's insistence on lowering interest rates. Even if he requests it, I will make a decision based on the data, and I will not be swayed by pressure, revealing his opinion. Therefore, if you talk about the lack of flexibility in the Federal Reserve, the market could only fall again. That's how you see it. Well, next is Monday. On Monday, Trump played golf. The chairman of the Federal Reserve said there is no more quantitative easing, and then Trump immediately said he would have to cut the chairman of the Federal Reserve and conveyed this message to the market. President Trump criticized the chairman of the Federal Reserve for being too cautious about interest rates and was biased politically. He sent a message warning that he could act very quickly if he wanted to. On the other hand, Chairman Powell said he has no plans to step down until his term ends in May next year, and that the president's power to dismiss him is uncertain. However, on the betting platform of the market, the probability of Powell's resignation within the year was only 12.5% a month ago, but it has rapidly increased to 25% in just a month, reflecting the market's concern. That's how you should see it. And furthermore, key figures from the Federal Reserve and the International Monetary Fund are worried about the instability of the global financial market in the face of the unpredictability of the year. It seems that the market's uncertainty and worry have increased a notch as they deliver such unfavorable messages. What's the next content prepared? It's today's United States stock footage. It would be nice to hear the expert opinion on the market today as well. Trump has been intensifying his attack on Powell in the future, hasn't he? So there's a bit of unease in the market, and we'll try to listen to the opinion of an expert named Katerina Szymanity on this matter. Katerina Szymanity is the Vice President of Morgan Stanley. It would be great if we could listen together to what kind of opinion she offers about the current situation where the balance between Trump and Powell is increasing in such a market and situation. Next.
The guest does not worry about the president's criticism of the power chair. This is Katerina Szymanity from Morgan Stanley Private Wealth Management. Thank you for joining. You're not worried at all? Do you see this statement as the president simply reinforcing his position that interest rates should be lower?
This is not the first time the president has criticized the chairman of the Fed. Around 2019, he even referred to him as a golfer who can't putt. The administration may have its opinions, but Chairman Jay Powell has 1 year left in his term, and he intends to complete it. At the very least, that's what I believe should be done. I believe it's appropriate that decisions about interest rate hikes, like any independent institution, should be made cautiously based on data. And certainly taxes can be a strong factor that can trigger inflationary pressure. Yunjun needs to thoroughly analyze the data and take time to observe how the effects of this policy are reflected. While recent indicators have been positive, they do not immediately reflect the impact of tax policy. This is due to the time required for emergence. Therefore, it is natural to approach this decision with caution as the effects will be seen over time. We believe there is no possibility that the Federal Reserve will raise interest rates this year.
Am I being too cold-hearted? I can't help but wonder if the president will ultimately not attempt to impeach the Speaker of the House in a situation where the United States government has to refinance over $9 trillion in debt. In fact, if the support for Chairman Powell is not high and the president's support is rather higher, I think it might be right to just let go of Chairman Powell. What do you think? In the end, in a situation where we have to refinance the debt, isn't it necessary to lower the interest rate no matter what situation arises now? Is that the essence of this mechanism?
All options are open to the chairman of the second wave of the Al-Daishi. As time passes and data is accumulated, it will certainly be carefully examined whether to adjust the level of monetary tightening. The Fed is collecting as much information as possible and will carefully analyze how these factors will affect growth and the overall economy. It's one option to consider, but it's premature to make a decision now. We need to watch a little more. This policy not only affects inflation, but also the overall economy and corporate performance. And as the year-end approaches, we need to watch how it will affect the overall positioning of the market.
I'm curious about a specific part. Do you think such political dynamics, where the president and the parliament are in such a strained relationship, have an impact in a situation where the parliament is considerably constrained? Do you think that in a situation like this, the parliament should rather take a stronger stance? Or do you think that the parliament is already trying to maintain the standards they have set? In my opinion, the Federal Reserve hopes not to intervene excessively in the economy or market. It's the position that fiscal policy can't be a panacea after all. I think he's more on the side of doing nothing is the best. Isn't the crucial point that in a situation where the level of both sides' statements is rising as it is now, one side will eventually have to give in more?
I think it's perfectly reasonable to see it that way. Another important point is that from the president's perspective, the effects of fiscal policy can be very significant in the long run. So it seems like he's encouraging investors to focus on long-term gains rather than short-term risks. However, from an annual perspective, the short-term effects are more important. In fact, the Fed makes decisions based on the data released every month. What we're seeing now is a clash between the long-term perspective of the Treasury and the short-term perspective of the Fed. While the Treasury is formulating policies considering the long-term benefits of the entire country, the Fed and its chairman are more focused on inflation, the possibility of an economic downturn, and short-term economic growth. Until the long-term effects become apparent, the Fed is in a situation where it can only make judgments based on the data in front of it.
The last article prepared for today has a bit of volume. The title is "The Probability of Stagflation is Rising," which is not very good news, but I will try to get some help from artificial intelligence that I have trained as much as the volume of this article. It's a long volume that goes over 10 minutes. Lastly, I would like to share my detailed opinion on what kind of investment strategy would be good in a situation where the probability of such stagflation is rising. That's it for today's broadcast. I'm still not fully recovered, so the broadcast may not be as smooth as before, but I will gradually recover and try to send a more comfortable broadcast tomorrow and the day after, which will be helpful to you all. We all fight together until the day we retire our investments in United States stocks. Have a happy day. Thank you. Thank you. Existing consumers are already suffering from high prices, and now we are facing the risk of a stagflation where economic stagnation and price increases occur simultaneously. Stagflation refers to the phenomenon where the rate of price increases while the economic growth rate stagnates and the unemployment rate rises. Professor Branhouse of Columbia Business School's economics practice said that Trump's fiscal policy has fueled both high inflation and low growth risks. According to Consumer News and Business Channel's Rapid Update, an average of 14 economists forecasts the current risk of stagflation is more pronounced than at any time in the past 40 years. Greg Dyko, chief economist at Oxford Economics, assessed that the current situation is the most pronounced risk in 40 years. Uncertainty is already reflected in the Consumer Confidence Index. Diane Swank, chief economist at KPMG, said that the fear of inflation is expanding as employment insecurity grows, and we are seeing the beginning of a stagflation situation. In the 1970s, the United States experienced stagflation due to the Vietnam War costs and a decline in manufacturing jobs. At the time, people even had to wait in long lines at gas stations due to oil prices, but some economists argue that the main cause was actually changes in monetary policy. In the end, then Federal Reserve Chairman Paul Volcker implemented the Volcker shock, which drastically raised interest rates. This managed to curb inflation, but it also triggered a deep recession with 2 consecutive quarters of negative gross domestic product growth and an unemployment rate of over 10%. Dan Suzuki, the market research director at Richard Bernstein Advisors, says that stagflation will not occur today as it did in the 1970s. The United States is now less dependent on foreign oil, and rising oil prices do not trigger inflation as strongly as before. However, the uncertainty caused by taxes could undermine consumer confidence in businesses and potentially slow down the economy. Many businesses are adjusting economic forecasts to account for a potential slowdown due to Trump administration policies. Stagflation is not necessarily defined by a continuous 2-quarter gross domestic product decline, but also by a stagnation or slowdown in growth rates, explains Professor House. KPMG predicts that inflation will peak at the end of the 3rd quarter of this year and then gradually decrease. If stagflation occurs, high unemployment and rising prices will simultaneously burden households and businesses. To prepare for stagflation, American families must manage increased spending, declining job opportunities, and high inflation at the same time. Economic analysts at Bankrate warn that in order to prepare for stagflation, all measures must be considered, including tightening monetary policy and dealing with high price periods. With potential tax hikes, buying large items in advance may be feasible. However, ensure ample budget for estimate adjustments within the budget range. Rather than panicking about inflation, it's important to prioritize dealing with high-interest credit card debt and non-essential spending. Experts recommend having at least 6 months' worth of living expenses set aside as an emergency fund. Fortunately, due to the current high interest rates, money deposited in online high-yield savings accounts can also earn interest that offsets inflation. Morgan Stanley strategists suggest that investors who have been holding a lot of cash should consider increasing their exposure to riskier assets like stocks, given the recent stock market adjustment. Investors with substantial gains should rebalance their portfolio to a moderate level. The situation can change. It's not confirmed that stagflation will occur. In a 2022 survey, 80% of economists pegged stagflation as a long-term risk, but it was able to be avoided at the time due to robust growth, disinflation, and a tight labor market. The danger we face today primarily stems from misguided fiscal policies, so by reducing policy uncertainty, completing immigration reform to increase labor supply, and reversing excessive taxes on major trading nations, we can reduce the risk of stagflation. A House professor stressed that the once thriving economy until 2025 is now threatened by recent policy changes, urging a reversal to avoid stagflation. Mijin's comment: if we were to summarize the current market situation, if there is no sudden change in Trump's fiscal policy, the future economic environment could potentially show a complex combination of slow growth, high prices, and high interest rates. There are experts who predict a perfect storm of slow growth and creeping inflation in the face of uncertainty, but in the worst-case scenario, there is also the risk of a more exciting recession, or, in the worst case, stagflation. In such an environment, the stock market is generally volatile and easily subject to valuation adjustments. Growth stocks are particularly sensitive to interest rates and economic shifts, so monitoring market indicators and hard data is more crucial than ever. Conversely, if inflation stabilizes in the coming periods and the Federal Reserve shifts to a steady rate policy, it could greatly reward investors who increase their stock allocation at the end of quantitative easing and rate hikes. In conclusion, the success of the overall investment strategy for tech stocks and growth stocks is expected to vary depending on the direction of the market indicators. So what should we do? Unless you've borrowed money to invest or are investing with money you'll need in a few months, I think it's a time when a prudent approach is needed to use distribution while managing risk rather than disposing of stocks in a panic due to excessive distribution. The specific investment strategies that our growth investors can adopt in the current situation are as follows. These are just my personal thoughts, not the definitive answer. 1. Check the valuation and focus on fundamentals. There is a need to re-examine the valuation of tech stocks which are currently the main holdings. If the current premium is excessively high compared to the fair value or the expectations are too high compared to the actual results, there is a high risk of a crash if the market further declines. There is a need to consider reducing the weight of such stocks or replacing them with growth stocks that have more favorable fundamentals. Companies that provide essential technology infrastructure for the fourth industrial revolution, such as software companies with clear economic moats and pricing power, cloud, semiconductors, etc., can generate relatively stable profits even in volatile market conditions. By focusing your portfolio on growth stocks with robust fundamentals, you can quickly recover even if there is a short-term downturn. At this point, it is not recommended to drastically reduce the proportion of stocks in your portfolio in the short term. As I have shown through historical data many times, if you sell all your stocks in the market, it is easy to miss the rebound afterwards. However, some defensive adjustments can be considered. For example, if you strongly believe that your stagflation scenario will become a reality in the next few months, you can consider reducing your stock weight temporarily by about 20% and increasing your cash weight from 90% to 70%. This can mitigate the shock in a downturn and reduce the serious burden. The important thing is not to leave the stock market. From a medium-term view, having no stocks risks missing opportunities, especially after extreme uncertainty. Markets often rebound from such points, which should be kept in mind. With the monitoring of 3 warning signs and a sensitive response, the future is not yet determined. It cannot be predicted, only responses are possible. Therefore, we must flexibly adjust our investment strategy based on future macroeconomic indicator changes. We must track monthly changes in stance on the annual inflation rate and adjust investments towards the side with increasing probability. If inflation rises faster than expected and the annual rate sends a signal of policy completion, this is a strong negative for growth stocks, so it is important to sufficiently hedge the stock weight. At that point, it would be more direct to reduce the weight of cash and bonds that were held for the previous defensive purpose and increase stocks. On the contrary, if the price is rapidly rising or the signal of a shortage becomes a reality, even if the unemployment rate, company, etc. are rapidly reduced, it is necessary to quickly respond by reducing the weight of stocks. In order to respond flexibly like this, you need to get rid of the misconception that there is no loss until you sell the stock, and you can move quickly according to the change of the situation. The stock market is like a poker game. It has a beginning and an end every day. Every morning when the market opens, all investors should remember that they are given another opportunity to bet anew. While the current market is often swayed by stagflation and economic slowdown, from a long-term investor's perspective, it is not advisable to significantly reduce stock weight due to excessive pessimism. Instead, a strategic approach leveraging market volatility is necessary. When looking at past examples, investors who held on until the end and bought more at the bottom when fear was at its peak were more successful than those who panicked. However, this does not mean that it is an absolute rule. However, there is certainly a possibility of additional short-term drops, so it is necessary to secure cash as suggested, establish a safety zone by buying in stages whenever the situation improves, and strengthen the portfolio qualitatively. By doing so, you can prepare for any additional drops and ultimately maximize your gains in the next upward cycle. In a market as volatile as now, the most important thing is to stick to your own principles. You should discard emotional judgments, remember the investment lessons that data and history tell us, and bet on the side with the higher probability. The current distribution will eventually pass, and when the rebound begins, there will be an opportunity for profit to those investors who remain in the market with a solid portfolio. While economic cycles periodically repeat ups and downs, the value of technological innovation is established in the long term. Therefore, even in today's difficult circumstances, if we face the great wave of the fourth industrial revolution and respond proactively, when we look back, we will be sure that today's decision was the right choice. We hope you will become a wise, proactive investor who uses this opportunity to achieve long-term investment goals, rather than being swayed by the distribution. Thank you.